On behalf of all of us at the Tepper School, I'm John Sangenberger, Executive Director of Alumni Relations, and I am delighted to greet you on this first official day of fall and welcome you to today's webinar on the new wave in FinTech. We are committed to always providing the Tepper community with access to our outstanding faculty, staff, and alumni experts via a multitude of our lifelong learning opportunities, and are so glad to welcome you to our virtual classroom today. We're also so happy to have all of our students back on campus again and to be in the incredible Tepper Quad. First, let me give you a couple of announcements. As we go to our next slide. It's time to begin your nominations for the 2022 Tepper Alumni Award. It's open, and we want you to consider nominating a classmate for one of our 5 alumni awards. You have from now until the beginning of December to get those nominations in, so start thinking now. We also have some upcoming webinars for you, 3 exciting webinars coming up. We want to highlight next week's Alumni Entrepreneurial Journey of 5th season. It's a vertical and robotic farming pioneer here in the Pittsburgh area. It'll feature an alumni panel moderated by Professor Dave Mawhinney of the Schwartz Center, and you'll get an inside look at this amazing technology and meet the co-founder and CEO, Tepper alumnus, Austin Webb from the class of 2017, and 2 other Tepper alumni who are part of the 5th season team. That's going to be next week on Wednesday, September 29th. We also, in October, have 2 great alumni webinars coming up. We've got a panel on corporate boards hosted by Professor Bob Damon, and a refresher on negotiations with Professor Lori Weingart. So I know you'll want to mark your calendars for those. Before I introduce today's speaker, let me also thank you for all of your support, your continued support of the Tepper School and of Carnegie Mellon University. It's your support that allows us to continue our vital academic mission. And now let me introduce our speakers. First, Professor Param Singh will be moderating our panel today. He's the Carnegie Bosch Professor of Business Technologies and Marketing and Director of the PNC Center for Financial Systems Innovation at the Tepper School and Carnegie Mellon. After his undergraduate studies in India and graduate studies in Texas Tech, he received his MA and PhD from the Foster School of Business up at the University of Washington. He joined the faculty of the Tepper School in 2008, so many of you may have had him, and he's taught undergrads, MBAs, and PhDs. He's an award-winning faculty member. He's the youngest recipient of the prestigious Informs Information Systems Society Distinguished Fellow Award and received their inaugural Sandra Slaughter Early Career Award in 2015. He also serves as Senior Editor of Information Systems Research and an Associate Editor at Management Science. You'll hear about his research in deep learning, machine learning, computer visualization, social media, social networks, and all the things that he's doing on our program today. Now I'd like to introduce our alumni panelists. We've got 3 outstanding panelists in the FinTech space here. First is Monel Amin. She is from a founder and CEO of Digilance Vault. She received her bachelor's degree in electrical engineering in India and came to the Tepper School for her MBA in 2005. She began her career as a software engineer in the telecom industry before attending Tepper, and then after Tepper, she joined Citi, where she had several roles in industry as head of liquid investments, alternative assets, and investment risk. In 2014, she launched Digilance Vault, a global 2-sided digital vigilance platform for asset managers and investors in the investment management industry. So you're going to hear about that today. Then we have Shamir Karkal, who's also from the class of 2006. He's the co-founder and CEO at Scylla. He studied physics and computer science at Bangalore University and is a 2006 graduate from Tepper. A true FinTech pioneer, Shamir played a crucial part in building the infrastructure that would pave the way for online banking. In 2009, with his classmate, he co-founded Simple, the first bank of its kind in the United States, serving as CFO. It was acquired by BBVA, and he led the open platform for BBVA after the acquisition. But in 2018, he co-founded Scylla with the goal of empowering financial innovations in smaller companies. In 2016, though, he was also honored with the Tepper Recent Alumni Achievement Award. And our third panelist today comes from the class of 2009, Dave Passavant, who is the CEO of Numo. Numo is a FinTech incubator subsidiary of PNC Bank. He's also the chairman of Triple, a next generation card linked offers platform where FinTech meets AdTech. So I know you'll have questions about that. He holds a degree in computer science from Washington Lee University and received his MBA in 2009. He started his career as a software engineer and consultant at Accenture. He was then an early employee at the billion-dollar Silicon Valley startup Steam and Square Trade. After Tepper, he led the digital innovation group at UPMC before joining PNC as head of innovation. And then he founded Numo with backing from PNC in 2017. A great lineup of panelists. Now let me hand over the reins to Professor Param Singh and our expert panelists. Param?
Thank you, John. And welcome, everyone. Welcome, Monil, Shamir, and Dave. It's a pleasure to have you as part of the panel here. And I hope to learn a lot about FinTech from you and all your exploits in this area that you have been doing. Now, in terms of the panel, in the next 1 hour, we'll talk about the FinTech phenomena and more importantly, what holds for FinTech in the future. Right? So just to give you a little bit of background, if you have ever paid something using Apple Pay, or you have split a dinner tab with your buddy using Venmo, or deposited a paycheck by snapping a photo on your smartphone and uploading it to your bank account, you're already part of this multi-billion-dollar industry called FinTech. Okay? So if you think about FinTech, at the core, it is simply use of technology to provide financial services. Okay? And it refers to everything. Anything that we touch nowadays is FinTech looks like. It refers to everything from cashless payments to crowdfunding platforms to robo-advisors to cryptocurrencies and smart contracts. If you think of cutting-edge innovations, AI, blockchain, they're reshaping and finding new ways of doing business. And as a result, many industries or many fields like banking, loans, insurance, personal finance, venture capital, wealth management, they are all facing disruptive new business models, or at least getting a new digital facelift. Now, why are we talking about FinTech? If you think about financial sector, it is very old sector. And FinTech is not a new technology. Actually, if you think very long back, we had ATMs. They were the FinTechs of the time. Okay? As technology changes, new wave of technology comes, we see a new wave of FinTech coming in. And FinTech, the financial services sector isn't typically synonymous with nimbleness. So this is one of the key reasons why the sector is ripe for disruption through technological innovations to improve customer experience. Okay? But this is also a sector where disruptors or innovators face serious challenges. Financial sector is one of the most regulated sectors and is dominated by large incumbents. So just to give you a perspective, even though we talk about FinTech and the buzz about FinTech a lot, just to give you a perspective about the growth, if we think about the full financial sector, it is expected to be worth about $26 trillion. And if I take the market share of the FinTech unicorns, the 48 FinTech unicorns, that would be less than 2% of this total financial sector. So even a lot of work is going on. There is a lot more to be done in this space, and a lot of opportunity out there. And our panelists are taking advantage of that opportunity and moving the whole industry in a direction where we think the next wave of FinTech is moving. So with this background, let me start with Dave Pescivant. Dave, you are part of a big bank. You worked at PNC and continue to work at PNC. You're also leading its innovation through an entity called Numo. You are the CEO of Numo. This is a unique entity. You are part of PNC, but at the same time, you're independent in terms of what kind of innovation you want to focus on. Could you talk to us about a couple of things we would want to know, like why banks find it very hard to innovate on their own, and why you may think Numo could be an approach for banks to pursue as they try to reshape for the future?
Okay. Yeah, thank you, Param. To the first question, I think banks are large highly regulated companies that are very happy in sort of an incumbency position that has been, I think, well defended for many decades structurally, essentially because of regulation. I think at the end of the day, there's a shift that has happened starting probably, call it 20 years ago now with the birth of the internet, but now actually coming into fruition in the past 5 years, where banks have shifted from being a relationship sort of company, a sort of a massive entity that exists in a complex regulatory framework and enjoyed the sort of spoils of that position, into essentially being a technology-led, technology-driven organizations. And that is a change that is exceptionally difficult to make. Okay, and that's, at the end of the day, making that change does not happen because somebody says they're doing it or somebody says they're innovative or you hire a few more engineers. It is like a change in your DNA. So that's my sort of belief, is the game has literally changed. The game that the banks are playing is literally changing. It was slow at first and now it's not slow. And that's why it's been so hard to change. You can't literally change who you are overnight. So that's the maybe short, complicated answer on that. As far as Numo's one model for innovation. Banks, many of them have FinTech incubators. Many of them take investments in early stage companies. This was purely just kind of a unique take on how I thought a bank could actually give birth to real FinTech companies. And when I say real, I mean companies that are not like a project inside the bank, but at a separate tech stack, entirely separate ownership structure. Those things that make, with employees having ownership in what you build, those things that make real startups work. Like, I wanted to sort of see if there was a model where you could have sort of the best of both worlds. And that's what Numo is. I don't know if it would work other places or not. And we're still, making it work at PNC, but, we're into some exciting stuff.
Thank you, Dave. Just a follow-up question, actually. This is based on some of the questions we are also seeing here from the audience. Your relationship with the banks, is it possible that a bank's true core competence is dealing with regulation? And when you look at it, you get some advantage as being part of connected with a bank to take advantage of that, but at the same time being very nimble in terms of doing the innovation? Does that help you?
Yeah. So on paper, I would say yes. Like when my glass half full answer would be yes, absolutely. That regulatory expertise should be an advantage for me. In reality, the answer is it's both. In some ways, it has been an advantage. So specifically, we at Numo launched a nationally chartered, essentially neobank account called Indy for gig workers. And we did that pretty quickly using PNC's banking charter. That's wonderful. It's easier to do now with other sort of FinTech banks that are out there, but it's still fairly complicated. At the same time, I want to do, 3 releases a day of my product, and I want to push the envelope on some marketing and things that give shivers to certain people. So the answer is, it's both. It is both an advantage and a disadvantage. And I know that's sort of a cop-out answer, but it's actually also true.
Thank you. Thank you, Dave. So let me move on to Shamir. Shamir, you launched the first neobank, Simple, which was acquired by BBVA, which got acquired by PNC eventually. And now you have a new startup called Scylla. And as I understand Scylla, it's very amazing. It looks like Amazon Web Services for FinTech products. Means you are going to be a platform which will allow other FinTech startups to take advantage or build on top of this. Can you walk us through a bit in terms of what major challenges you saw FinTech startups facing and how Scylla is actually providing some solutions to that?
Definitely, Param. So, the genesis of Scylla is really based in kind of my experience and my co-founder's experience in starting Simple and other, fintech companies. So it took us 3 years to launch Simple, from first email to the first like 500 customers, right? And that's not because it takes 3 years to build a web app or build a mobile app. 2.5 of those 3 years went in finding a bank partner, because getting our own bank charter was not an option back then, and I don't think it's a realistic option even today. So find a bank partner, find a processor, figure out that that's not going to work, and find another bank partner and like 4 more processors, and figure out how to connect all of them. Learn a lot about compliance along the way, and then build and ship the web and mobile apps. We used to joke at Simple that the only thing simple is the name, and that what customers saw, which is they interacted with the web and mobile apps, that's like the tip of the iceberg, right? All the plumbing underneath to support that was a lot of work to build, and it takes a lot of time even today, right? Like if you want to kind of replicate Simple's sort of model, which pretty much every neobank does now, it's going to take you 18 plus months, maybe not 3 years. There's an industry of like partner banks, there's more processors. Things have improved in 11, 12 years, but not that much. Now, if contrast that with a developer who wants to program with, let's say, email or voice over IP or SMS or any internet protocol, really. It's quick, it's easy, there's APIs, SDKs, there's a whole ecosystem of providers. Really, the hard thing to do is to compete with Gmail. But again, most people who are programming with email are not building Superhuman or Hey or an email client, right? They just want to embed some email flow into their business app. And honestly, it's easier to do it than to talk about it. So it's just like an afternoon's work for a developer in most cases. The moment you want to program with money, you realize that it is a very different world. There is no internet protocol for money. I mean, there's a lot of people trying in the crypto space, but nobody's even close yet. And it matters a lot whether you're in San Francisco or Shanghai. It's heavily regulated. And you end up having to work with banks, maybe 15, 20 in the US who will partner with an innovator, maybe 500 globally who will work with somebody who wants to build something new. And for lack of a better term, they kind of all suck in general, and they just suck in different ways. They're outdated. Their technology is 20 to 50 years old. They are heavily regulated, and they don't know how to manage that. So then you as a fintech have to become an expert on regulation. And maybe the biggest problem is that they just don't understand developers and developers as a customer base. So if you want to embed an email functionality into your app, don't waste time talking about it, just do it and it'll be over. If you want to embed a money capability into your app, please, can you find a different business? Because it is just so hard, and we're talking 18 months versus 30 minutes, right? And that is the fundamental problem we want to solve. We want to make it as easy to program with money as it is to program with email or any other. And money fundamentally is just a specialized type of messaging system, right? So the way we do that is through the core product is a REST over HTTP API platform that allows our customers, which are mainly businesses building applications. It allows them to onboard their users, individuals and businesses, verify their identities, link their bank accounts, pull money from those accounts, push money back to those accounts, hold the money, transfer it, and program with it in a variety of ways, including on crypto platforms where we support a stable coin on Ethereum and probably in many more blockchains and many more platforms eventually. And really, that is our goal. It's kind of like what AWS did to building a website, we want to do to building a fintech startup.
Thank you, Shamir. This is very interesting in that. As a follow-up, because you are actually supporting a lot of fintechs. Are there specific kind of fintechs that you are seeing any change in this that you are seeing over time? Like, are there like different kind of fintechs that are showing up on the platform now compared to the past?
The variety is, I mean, we've launched 2 years ago, so we're still a very early stage company, but not that early stage, right? Like we've been around for like 3 years, launched 2 years ago. I think what we have seen is in some ways just a natural evolution of the business. If you look at our first 4 customers from like October of 19, they were all like super early stage, right? Like I wouldn't even call them seed startups, I'd call them pre-seed startups. One of them shipped their app and then went and did a demo at Techstars of the functional app, which was huge for them to be actually in an accelerator and be able to demo a working version of an app, not just a prototype, right? Now, if I look at our 100 plus customers today, we still have a lot of similar companies, pre-seed and very early stage companies. But I would say the median company now is probably a seed or maybe even a Series A startup. We have a lot of like seed, Series A, even some later stage, even one company that's public, right? And so we've kind of drifted up market just because in 2 years, some customers just got bigger and bigger. But also a lot of it is just later stage companies, heard about us and started discovering our capabilities. And it's just like, if you're a pre-seed or seed, fintech, crypto, insurtech, wealth tech, reg tech, whatever you want to call it, if you don't build and ship your app, you don't exist, right? And you have to raise money every 12, 18 months. And if you haven't shipped your app, that's a big question if anybody's going to give you any more money. So it's just speed to market is completely paramount. If you're a publicly listed company on NASDAQ, you have a large and existing business. You want to build more capabilities and ship them. It just doesn't have the burning urgency that it does for an early stage company. So I think as we've gotten bigger and grown, we just have more later stage companies. But I think the universe of customers is all businesses that need money. And I really think that is pretty much 100% of them. Not everybody has an in-house development team building their own app. That's maybe, 2% of businesses. It's a small percentage. But whether it's directly or indirectly, it is, all business.
Thank you. Thank you, Shamir. Now moving to you, Monal. So you have been in the fintech space even before it became a buzzword. You started very early in this space. And your career actually is quite inspirational. And one of the things I have to say, finance and technology, both sectors are the ones where we don't see very many women entrepreneurs there, particularly. And you are at the intersection, not just an entrepreneur, but also a thought leader in this space. I thought this would be great for the audience if you could please share something that you have learned through your journey in fintech, and also about your new venture, Diligence Vault, which is helping reshape investment management. Can you talk us about that a bit?
Yeah, no, absolutely. I mean, after Tepper, I joined Citi, and Citi was just a wealth of opportunities given how big the firm is. And I think the exposure that I got at Citi was quite instrumental in why I started Diligence Vault, right? So I did capital markets, I did corporate banking, but then I spent a lot of time on the asset management side of Citi, where we were making investments in external fund managers, may it be mutual funds or hedge funds or private equity funds. And then we were also managing money for external investors. And I had seen a lot of the problem sets that we are solving today, right? And that was probably the reason why I left to start Diligence Vault. And if you go back to history, I think in my introduction, John mentioned that I've started my first career as a software engineer. And that came in very, very handy when I was starting Diligence Vault. And I think a lot of people who are non-technical, who are starting a tech company, always struggle with that, male or female, right? Is you need that technical co-founder if you're building a technology platform. And having that technology background and then having the exposure of actually working in that industry helped tremendously in building Diligence Vault or starting Diligence Vault. So what that is, it's far away from the payments, the banking, the retail aspect of FinTech. What it is, it's a technology platform which we call is a dating app between funds, may it be a mutual fund, hedge fund, private equity, crypto fund, and their investors, who are college endowments, hospital foundations, insurance companies, pension plans, which is the absolute end investors in the whole financial services spectrum, which is nearly $150 trillion market that a lot of us didn't know. I didn't know when I was at Carnegie Mellon. I got to know about that much later in my career. A lot of the diligence process that happens in that industry is still in Excel and Word and PDF and lots of email exchange, right? So there's need to digitize that entire information flow within that industry. Because $150 trillion all over the world, people are making billions of dollars of investment, but the diligence happens, which is very document driven. So that was the idea of Diligence Vault, is creating a two-sided marketplace of diligence where information flows as data points as opposed to documents. So it just opens up a brand new opportunity for both parties. The party that's consuming the information to analyze it, make better decisions, identify any risk flags, right? Because most of the times when they're making investments, if they're longer dated private structures, they're locked up for 10 years. If they're not private structures, then it's still, these are large investments that people are making. And then the asset managers almost face the problem that all of us applicants faced when we were applying to business schools. Every business school application is asking for the same thing, but in a slightly different way. So you have to recreate that whole wheel again and again. So we've applied a lot of natural language processing for the fund managers, because when they're responding to diligence requests, they may not look exactly the same, but they're similar enough 90% of the times, but people are doing a lot of copy and paste, right? So we've used a lot of recommendation engines to help bridge some of those gaps in this diligence ecosystem. So you're right, I started 7 years ago. It was a brand new space. No one really knew about this concept. So we spent a lot of time educating the market about why this is needed. It took us probably 3-4 years to get to 6,000 users. And in the last, I would say less than 2 years, we've gone from 6,000 to 30,000 users. So that's been phenomenal growth that we've seen. But it's all because of a ton of user education in the early days and sticking to what we know we wanted to do as opposed to trying to be in different segments. So that's a bit about Diligence Vault.
Thank you, Mona.
Sure.
So as somebody who's running Diligence Vault, you guys must be able to see like what kind of topics people are asking about, like investors are asking about, are sustainability or ESG kind of topics. Are these gaining more attention as you see in this diligence?
Yeah, no, absolutely. And I think it's at multiple levels. So our platform is end-to-end encrypted, but we do talk to a lot of our users who talk about these topics and who routinely reach out to us about, how do we think about changing our diligence framework and digitizing it when we have to collect a lot of this information, right? So when we think about sustainable investing, impact investing, ESG, whatever flavors that people have, there are multiple levels that people are thinking about this, right? So one, there is this acute focus on diversity, right? Diversity of the fund managers that most of the allocators are allocating money to. So there is a lot of data collection, a lot of diligence going in that spectrum. And it's a new field. So, there is a lot of ambiguity, but there are new standards that are emerging in that space, right? Another big focus for investors is climate. It's a huge focus. And, it was pretty common in Western Europe from the investor landscape that climate was such a big area. And now, it's taken a worldwide focus of its own. A lot of the investors, a lot of the fund managers in the industry are becoming net zero, right? And they're committing to becoming net zero. And that creates a far bigger data challenge, right? Because it's one thing to claim that you want to become net zero. It's a second thing to prove how you are becoming that, right? How are you reducing your carbon footprint? And that, again, creates a new opportunity for firms like us because everyone needs to have access to good data to measure the effectiveness or monitor and then provide insights and input into their investments. And that's, again, a huge data challenge. So we do see a lot of that type of data exchange happening as part of initial as well as ongoing diligence needs.
Thank you. Thank you, Mona. Let me open up questions to all three of you. So could you talk us maybe what areas you are focusing on in the FinTech as you think would be important in the future, or if you're not focusing yourself, but what do you think, where do you see the next wave of FinTech would come? Where is it going?
Me to start, take a stab at it. Just
go for it, Dave.
Thanks. I don't it. The movement is such a big sort of multi-currented thing that I don't believe that per se the next wave will be X. Certainly, I believe the platformification. Sorry for the non-word, but that's a real thing. And Shamir's in the middle of that now with what he's doing, and other companies doing the same thing. That's terrific. The decentralization of financial services is a real thing. That's going to continue to happen. So those are real. I tend to think of then what I call sort of just a redefinition of what companies do. It's right for big banks to sort of redefine what's the actual service that you provide, and then to rethink how you provide that service. So that's going to continue to happen. And then I think finally that this concept of regulatory change, or I use the word re-regulation, will be real. And over the next, call it 5-10 years, regulators in the US, which is really what I know, have to struggle with the questions that the mass consumer adoption and corporate adoption of quote FinTech products that are run differently. Regulators will have to struggle with, what does that mean for us? What does it mean for our regulation? There will be blowups. There will be money lost. There will be people screwed over. There will be all these things will happen. And, if anyone who's worked in a regulated industry knows, the one thing, it's tough for regulators to adapt intelligently quickly. It's a hard thing to do, but that's going to be a real sort of, I think, third current that I care about. So that's how I see sort of, I guess you call the next wave of FinTech. I think all three of those currents are real. For us at Numo, I don't ever though, we are very opportunistic, meaning we just look at ideas that come across our desk and we sort of match them up to a rubric we use to determine, is this a good fit for Numo to build this kind of company, given who we are, given our connection to PNC? And if it is, then we score it and we move on. So we're in the sort of payments and neobanking area. We have one company that is in the sort of regulatory area, and then another company that is in sort of a newish space, which is this sort of FinTech and ad tech together. So those are the areas that I'm working in right now.
Thank you. So Shamir, you have something to add?
Sure. So I think the whole sector, you put it well right at the start, Param. It's 2% by kind of valuation. But if you look at other metrics where like revenue, I think it's maybe 1% if you count every FinTech from PayPal to Scylla as a percentage of global financial services revenue. And that most of that is probably PayPal, not Scylla. But if you look at transaction volume or other metrics, it is actually way less than that. And so but the thing is that it is the fastest growing chunk of it, right? And I think this decade, in the 20s, FinTech, and I agree with Dave, FinTech is kind of a broad, I would include all of crypto as well in that, and kind of other regulated payments tech like InsurTech and all of it. I think it's going to go from 1% to 10%. So global financial services is controlled by 99% by 30,000 banks, broker dealers, insurers, and traditional financial service companies. That is still going to be 90% true a decade from now. But that journey from 1 to 10 means that the whole industry is going to grow by 10% on meaty metrics like it's going to grow 10x, sorry, on meaty metrics like revenue. Valuation, I would suspect, will grow even more. And I think in terms of like transactions and other things, it's also going to be more than 10x growth. So I think in 2030, FinTech as a sector will be bigger than all of tech in 2020. Which means that we will have a handful of trillion-dollar fintech companies. We will have dozens of $100 billion fintech companies, and we will have, I don't know, hundreds of fintech unicorns. And where are those companies coming from? Well, but when you're talking about the trillion-dollar ones, it's Stripe, Square, PayPal, Klarna, Alibaba is in a different space right now, and all of those companies are big and they're not stopping. They have no plans to kind of like stop growing, and if they continue, then 10 years from now, that's where they should be. But there is a whole wave of companies being started in the last 2 years and today, which will be unicorns in the next decade, and that's where it's going to come from.
Thank you, Shamir. Monel?
Yeah, and I mean, great points by both Dave and Shamir. And I think one area that we are seeing fundamentally is a lot of the financial service infrastructure is siloed and not really interconnected, right? So that's a huge area for growth, is integration between different silos of financial services. A huge portion of also financial services is a lot of manual processes. So automation is going to be a big wave as well, whether it's micro automation or major automation, right? And I think that's where a lot of robotic process automation, AI, ML applications are going to come through. And then lastly, I think there's one of the audience questions as well, access, right? So the way people access financial services, the way people access investments, that is fundamentally shifting. So I think those are the three other trends to watch and see, how these would transform. Now, some are definitely, user facing, so user experience comes a lot, but the infrastructure and the integration and the automation is a lot of back office. It's stuff that people don't see. It's the unsexy part of fintech, but it is a necessary part of fintech, and that is seeing a huge amount of transformation in just how people are using technology.
Thank you, Manal. So let me get back to one more audience question, and this is something that I also wanted to know. This is something like when cryptocurrencies came up, a lot of the banks or like government and so on, they were not sure what to think about it. Initial view was this could be something which is could be quite disruptive. Then they thought we could use it. Then they're still trying to make sense of what to do with it. But now there is this news about like potential introduction of central bank digital currencies. Okay? With this news coming out, how do you think it would affect the fintech industry? What are the implications for the fintech industry for that? Or not just fintech, even for banks, if you have any thoughts on that?
Monel, Dave?
No, I actually don't. I know enough to be dangerous, so I'm not going to do that.
So I'll go out on a limb here and say for fintech, none, and for banks, huge.
Dave, you want to say something because you know the banks a lot more now?
I've intentionally, we have deliberately not taken on any projects in the crypto world. Like it's not a leap of faith to say that a change in currencies from fiat to non-fiat controlled will shake up a whole bunch of things, even if it's just another viable option for doing business and for moving money in some form, right? Like that's a tectonic shift. And so it seems like that's going to happen. in some form. Exactly what it means, I have absolutely no idea. But it is fun to watch it play out. It was fun to watch it kind of rear its head, maybe 6 years ago or so, and folks were able to sort of hit a quick sort of bubble in terms of like crypto pricing, but also adoption of cryptocurrencies. Then it kind of went away for a little while or quieted down, and now it's another sort of super cycle that will continue. I do believe, So something meaningful will happen. I don't know what it will be. I won't claim that I do, Param. Otherwise, I'd be on a boat somewhere.
I'm happy to elaborate. I mean, I think, as I said earlier, banks fundamentally struggle to understand how to serve developers and innovators, right? Like, it's a customer segment that they have never served. It's a segment that's fairly new anyway, and they just don't know how to do that. But if you think banks are bad at serving developers, you should see central banks, right? Like, so it's like central banks' customers are banks and have always been banks. So it's kind of like, if a tree falls down in the forest and nobody sees it, like, does it matter? If a central bank decides to issue a fiat currency on its own private blockchain and invites the 50 banks in Singapore or the 75 banks in Hong Kong, whom it has always dealt with using, old school mainframes, and now they are all transacting using new age blockchain technology, it makes no change. It probably speeds up the system and makes it more efficient. New technology is usually better, but from an impacting fintech perspective, it has very little impact, right? So again, central bank digital currencies, as Dave said, it's a topic that's back in vogue and people love to talk about it. It could be potentially like massively disruptive and potentially have basically no impact at all beyond like smoothening some operational processes between central banks and their existing large bank customers. And I'm like, well, if you're sitting at a central bank and you're designing a central bank digital currency, which way are you going to do this? In the way that's massively disruptive to the entire global financial system, or in the way that makes your existing job a little bit easier? I think I know which way that's going to play out.
Thank you. Thanks, Shamir. So just as I was looking through your backgrounds, all three of you started in the tech space and then moved to finance and eventually fintech. Do you think that's a background? That's something that helps you in identifying opportunities and what can be done in the fintech space? Can you guys talk about that?
I guess I can probably share my own experiences. I don't know. I mean, I know a ton of fintech founders who are non-technical, so I know that can be done, right? I think it's about understanding the problem set, right? And knowing the technology background definitely helps in getting to the execution, right? Because I think if you know the problem and if you can also execute to a solution, it's definitely faster. But I do know a lot of people who are non-technical, who build fintechs and successful, right? I mean, they struggle in the early days because you have to trust someone else to tell you what can be done as opposed to something that you can do yourself. But I think that's the only comment I can make. I don't think it's one way or the other. I think the life of a company, whether fintech or any company, right? It just goes through so many different challenges. Every day is just a different day. And those challenges are probably what people really focus on to get it to success to the next level.
Thank you.
So I agree. I agree with Manal. There is no correct recipe for being an entrepreneur, right? What's most important is that you just see the world a bit differently than what exists today, and you pursue that with total conviction, and hopefully you're like mostly right, or at least a little bit right. That's what's important. Now, that being said, I can tell you, as a technologist, to my earlier comment, like, because the DNA of what to quote banks need to do now is actually be really good at building and releasing tech and managing it and understanding a customer experience that's driven by technology. Like that's the stuff that matters in financial services now. So it's not, again, like how firm is your handshake, and that's just a different mentality. So I found that it has been useful to be able to just question things coming in from the outside. Like that doesn't actually make sense how that thing is architected or how it works today. Even like organizational structural things, like the tech team isn't just like an order taker, right? This is the core, like this whole thought of having a technology team that was like some other thing that's off somewhere is just like, that's antithetical to all of my experience out in the valley before Tepper, right? Like, no, that's the product team. Like those are the people that are, building the thing, and they can be creative, and like, that's a shift in mentality. So I have found that, I guess at least that was part of what got me the license to have a totally different structure that's built more like that, rather than saying like, we're just going to change the bank to work that way, which is super hard to do. So I think it was a leg up for me, or at least allowed me to see the world differently.
Thank you. Shameer, you want to add something?
No, I think Monal and they were completely right. It's not a necessity by any means, but I do think it is an advantage to have a technical background. I think the most advantageous background is to have some sort of programming experience, back end or front end, but maybe back end more, especially if you're doing infrastructure stuff like we are, and then some business experience, and that's again, Zuckerberg and didn't even graduate college, right? Like there's a lot of very successful people who have very minimal backgrounds and still did amazingly well. So that you definitely don't need it. It does help, and to kind of emphasize Dave's point, the most helpful thing it is the ability to think about problems and solve them in a different way than has traditionally been solved. When you assign engineers to solve a problem, you get very different answers, right? Like they know how to code and they try to solve every problem with code, which is not always helpful. That can also be a problem sometimes. You don't want to automate everything all the time. But amazingly, lots of things can be automated, especially within banks, which you're like, we don't need to do it that way just because it's been done that way forever, right? Like we found this like document processing software, and now 60% of documents are accepted or rejected by software, and no human even looks at them and only looks at the exceptions. And it's like, whoa, so much productivity came from that, right? So things like that are how engineers think, and non-engineers typically don't think like that. But I mean, entrepreneurs have to think like that. So if you're going to be a fintech entrepreneur, technical background is not necessary. An innovative approach to problem solving might be. And if you have that without being an engineer, that can still work.
Thank you. So let me ask you another audience question on this. So this is a question which says, regulators and academics have expressed concerns about increasing concentration in the fintech sector and the market power of large banks. Okay? So now, do you view fintech or regtech as leveling the playing field, or it would be increasing the power of already the incumbents that are out there?
I mean, the powerful incumbents in this space are not Google and Apple, and definitely not Facebook. I mean, the powerful incumbents in this space are the banks, the broker dealers, the wealth managers, and the networks, right? Like Visa and MasterCard as well, and the central banks, of course. I mean, that it's still the set of companies that existed before 2000. So I'm like, that there is a future of the world where the GAFA, right, Google, Apple, Facebook, Amazon, become the giants of fintech as well. I they all have like fintech businesses that they have or that they're building. I think some of those businesses like Amazon is probably the biggest fintech lender in the country, and people don't realize they do a huge amount of lending through their marketplace, which just makes them a lot of money, and they don't talk about it. And but the I don't see them. I don't see them kind of like eliminating the rest of the fintech industry. Just because Amazon does a lot of lending doesn't mean that a firm is out of business. I mean, lending is massive, massive, massive business. There's a space for like lots of them. In fact, Amazon and a firm partnered recently, and so this sort of thing is going to keep happening. There are going to be quote unquote specialist fintechs. There's going to be the large tech who are going to embed some of the fintech from the specialist fintechs and from everybody else. And it's going to be like everybody doing co-opetition with everybody else. The losers are probably going to be the old incumbents. Sadly, at the moment, it looks like the biggest chunk of losers is the smaller banks and community banks and credit unions, who really have no technology capabilities, never had them, and are struggling more and more. The large banks don't have great technology capabilities, but at least they have some. I mean, they have armies of developers, and it's slow to turn a big boat, but it is big. It has a lot of momentum. They have some capacity to change.
And adding up to what Shamir said, I mean, we have a couple of big banks as clients, and I can tell you, when we started, it was always build versus buy. Now they're recognizing that, buying something gets them to point A to point B much faster, brings them efficiency. So a lot of them are very, very open to adopting now. I think 5 years ago they weren't, but they're really taking advantage of FinTech, RegTech to make their own operations better, to make their own access better, and their profitability better. So they are definitely getting better. More powerful, not sure, but they're definitely getting much better. So that equates to power eventually, but yes.
Thank you. Just to follow up on that, and as we are seeing, most of the fintech is trying to either move sensitive data online or to move money online, like transfer the money online rather than just the data itself is not just knowing your address, but just your dollars that are being moved online. Is the fintech more susceptible to cyber security? Do you have any comments on that?
I think that's a risk factor for, sorry, go ahead, Dave.
No, go ahead, please. I'll follow.
No, I think that's a risk factor for all of us, right? I mean, if you tell me what's the one risk that I'm constantly worried about, it's exactly that, because we are moving a lot of sensitive information for users in over 100 countries, and that just creates such a big exposure for you, right? So that's probably my biggest worry every day, and everything that we do. And I think the banks are too. So anyone who has exposures, who has liabilities in this space, everyone should be, because I think you only have to be wrong 0.001%. The hackers have to be right 0.001% times. The odds are against you. So we do spend a lot of time building risk management frameworks around here. Every piece of code that we write, we're always conscious about what security loopholes are we introducing. And then, that's a big part of our governance framework as well. And our board also discusses that quite a bit. So I think it's becoming a big, big risk factor for all companies. But over to you, Dave.
Totally agree. No, I completely agree. I think that for me, the short answer is that is just more a function of the decentralization and the digitization of financial services. Right? It's happening in more places by more people. It's not happening because the banks are great at being really secure. It's like if you have a walled off thing that nobody ever really goes into, it's closed and you play by their rules, then like, yeah, you can make that pretty secure. And that's what the banks had done for a long, long time. Like you can't, and like, maybe there's an app to check your balance or something, right? Like that world just doesn't exist anymore. So yes, there are certainly increased security risks. They are brought about by fintechs doing more things, maybe playing faster and looser. They're brought about by banks, like awkwardly trying to figure out how to be more open. And So both of those things are true, which is a whole different set of potential company ideas around not just cybersecurity companies, but products around identity theft protection, those sorts of things. Those will continue to happen. So yeah, I mean, all of us should be prepared to have all of our stuff stolen a lot more often over the next couple of decades. That's the world that we're going to live in.
I mean, before we had planes, we didn't have any plane crashes. So yeah, before the internet, cybersecurity wasn't that big an issue because there was no internet, but the internet isn't going away. And what drives cybersecurity is the fact that everybody's technology is getting more and more connected. And that has really less to do with FinTech and really just with the evolution of technology. And we aren't turning the clock back. So cybersecurity and cybersecurity threats are here to stay, and everybody just has to get better at dealing with them.
Thank you. So just as a follow-up on this then do you think regulation will become like more and more tighter on this because if there are greater risks now because of FinTech, is it going to be tighter and that could limit the growth of FinTech? So do you think we need a completely different kind of regulation? What are your thoughts on that?
So regulation is already getting tighter, but it's not regulation from the regulators, right? The standards that exist in I mean, there is some, right? Like especially outside the US, like GDPR, and then the new California law, what is it, the CCPA, and so there is some, but most of the push has been driven by for example, Visa and MasterCard with PCI and demanding that card data get more secure. And that all happened after there were a bunch of card data breaches. And I mean, becoming PCI compliant has not stopped the data breaches, but at least it has slowed them down. And it is definitely way more secure to be PCI compliant than non-compliant. It doesn't it's not like just doing that and wave a magic wand and everything gets better, right? So I think the true pressure is really coming from customers at the end of it. And it's being channeled in different ways, like through businesses, for example. Like for us at Scylla, as we get larger and we get larger customers, suddenly they ask about PCI, SOC 2, and all these other security standards. And we're working on all of them now. And it's, it's definitely harder than to be PCI or SOC 2 compliant than it is to not be compliant. But that's like saying it's cheaper to drive an unsafe car. That doesn't mean you should do it, or just doesn't mean you should sell it, and doesn't mean anybody will buy it if you try selling it, right? So yeah, I mean, it's just a cost of doing business in the modern world, and it's the flip side of on the internet, it's so many more customers, so many more hackers too.
Thank you, Shim. So we have 2 more minutes to go. So before we end, I think this would be a lot of people in the audience would want to know, get advice from you in general. So what is your advice for current student or even our alums who are on the call who wants to work on a FinTech or start a FinTech? What is your advice for them for launching a startup in this space?
I think my advice would be no different than any other startup, right? So have staying power, right? I think people see headlines of overnight successes, right? Not all companies are going to be that. That's almost a minority. A lot of people that I do know that start companies, tech companies, right? FinTech, edtech, whatever that may be, they realize 6 months later, it's too difficult. The clients are just not flowing in unless you have the perfect product market fit on day one, which is rare, right? That staying power is absolutely important. And a lot of people who are, if they are students, their risk tolerance is much higher, right? Because this is their first thing that they're doing. And I think the best way to start as a student is just, intern at a shop that what it really feels like to be part of a tech firm. Or if people are changing careers, then the worry is you have to get comfortable with not getting paid, right? unless you take funding, right? And that's another thing is, convincing. Now you're selling your idea and getting funding. So these are all the early day mental adjustments you have to make when you start a new company. And after that, it's a set of problems that someone else has already solved, and there are enough advisors out there that can tell you to the next phases. But the first phase is a personal commitment.
So when I was starting Simple in 2009, I also interviewed with a bunch of different companies for a job as well, leaving McKinsey, and there's mostly like corporate strategy jobs. And I got an offer from Hewlett Packard strategy team. And I flew out to the Bay Area, met the head of that team. And I was like, so listen, I'm like, I think this offer is like a little bit too less, and it should be like 15% more. But putting that aside, I'm working on this startup idea with a friend, and an investor just committed $50K. I'm trying to figure out whether I should go do that or whether I should, come work for you, right? And my potential boss's response was like, well, I think the offer is perfectly fair and it's right. But look, I live in the Bay Area. I have a house. I have 2 kids. I was at McKinsey myself, and I've been running this strategy team for 5 years. Do it for a few more years, and then go run a division. And then if I do it right, I have a shot at CEO. I couldn't go do a startup today, even if I wanted to. You, on the other hand, I mean, you got in this year. We hire 25 people into this team every year. I'm not saying this job will be here for you next year, but, and I was like, we don't need to discuss that offer anymore. Thank you. And it's exactly right. I mean, I was 30 years old, no kids, had money saved up from my time at McKinsey, and my risk tolerance was very high. I didn't quite realize it, but it was. And it's very different at different points in your career. So, but you do need a high risk tolerance, and you do need a lot of perseverance.
So I know we're over time, but I would just say there's an existing industry here that is undergoing like meaningful disruption, and that's a word that's thrown around too much, but it's actually true. So to any student that's interested in it, there are opportunities around every corner. You have to, though, really study how things work today in order to sort of identify how you can then uniquely solve a problem, right? So you got to put in the time, and you can do it by reading what kind of companies are getting funded, what are broad stuff all over the place, what kind of broad macro trends are impacting the world of money. But ultimately, to be an entrepreneur, like you can't just want to do it. You have to study a problem and have enough sort of conviction that you can connect the dots differently than people have in the past. That's no different here. The advantage is, though, there's just so much change and disruption happening. If you put in the time, I think eventually you'll find a point of view that will take you somewhere.
Thank you, Monel, Shamir, and Dave. This was an absolute pleasure talking to you guys and learning from you. And we will look forward to hearing about your exploits and your successes as you shape the fintech field and the whole financial sector as we go on. I think we are out of time now. So I think
thank you, Param, for hosting us today, for your insightful leadership of the call. So proud of our alumni and what you're doing. And thank you for all that you do for the Tepper School and for Carnegie Mellon, and all the ways that you give back to our students and alumni and help build our community. So thank you again, and look forward to seeing all of our attendees at our next webinar next week. Another amazing startup out of Carnegie Mellon, 5th season. You'll be impressed by it. So if you're interested in another side of technology and agriculture, join us next week. Thank you so much, and take care.